All right, recording on. Today is Wednesday, August 9th. We are starting week 5. Before we get into the content or anything else today, just questions about anything so far or for today? All right, can everybody hear me? Just checking the audio, okay, making sure. All right, so first thing I want to do today is to talk about Apple. You had an assignment, and then they also reported their earnings and crazy stuff happened with their stock. But nonetheless, as we talk about Apple, just asking if somebody's being willing to share their as is and just kind of talk through how you did the homework for Apple's as is. Who wants to kind of walk us through that?
I'd be happy to take a stab.
Great. Throw it on up.
Okay. Okay.
See your screens. Go ahead.
Yeah, I think the for the most part it was reasonably straightforward. The only one thing that we found, the report out that you gave us from JP Morgan actually didn't have anything to do with the tax projections. So we had to make some assumptions on that. I think we landed around 17.2 just as a looking at what they were doing this year, year to date, and we kind of used that as the forward projection for that number. So we didn't get much analyst input on that side. And yeah, I think hopefully most of the rest of the pieces are in place. Obviously, this ROIC was the number that sort of immediately strikes you, and it's like that must be surely wrong. But I think as we'd kind of discussed previously, the ROIC, if we're including all of the cash that they're holding, really doesn't reflect their true sort of return that they're generating. They actually have very low invested capital year on year, and seem to be generating well in excess of that every year. So that's the one that really stood out for us.
By the way, can you just quickly go to the ROIC drivers tab, which has the tree? And if you kind of scroll over, it's the invested capital to sales. I mean, basically for a company that size, they're spending 4 cents per dollar, 6 cents down to 4 cents. And so that's how you get a high ROIC, because they're making 30 cents per dollar profit on 4 cents per dollar of investment. Because, and you can see that, there, that big giant negative working capital, not much PP&E. But so just reinforcing the point that you just made, we also would have seen if we had done an ROIC analysis of Apple. But go back to what you were doing. Sorry for that sidetrack.
Yeah, I don't think we had much else to report on that was notable. Other than that, I think that was really the highlight. Trying to see, and we adjusted our continuing value EBITDA up slightly to based on sort of forward year projections, to balance that out at 32.6 for EBIT. Yeah, I think that's about it.
All right. So while this is up on the screen, questions from anyone else? I assume everybody got pretty similar numbers to this. So we're able to get to the $192 stock price. And then what was your G again?
7.5.
Okay. So basically, given the high ROIC, and to be honest with you, whether the ROIC is 50, 70, 80, or 100%, once you get to that high level of ROIC, it's not going to matter too much. But nonetheless, with very little reinvestment, which is what a high ROIC says, you're going to get a pretty high G. And so, built into the the company's value is the assumption that they're going to have a pretty high G. And by the way, if you go to the DCF value tab, notice that you came up with a $3 trillion valuation. So, Apple's been touching about 3 trillion in the real world. And I'm just saying, like, how do you get to be a $3 trillion company? You're actually seeing it here kind of modeled out in a cash flow basis in the valuation tab. So obviously it matched the stock price, but you can see, just looking at the value there, that operating value is right at 3 trillion. And it's coming from their very, very high expected free cash flows that those margins are basically showing. All right, great job on the as is. Do you want to go and talk about a bull or a bear since you're on a roll here?
I can. Let me open up that quickly. Yeah, so on
the bull. Okay, go.
Yeah, there's the bull. So I think the main thing that we took out of some of the analyst notes was, the slight transition into service-based products, which should be, in theory, slightly more profitable for them. At least that's what they're saying. So we felt like EBITDA, revising that upwards, we were probably quite aggressive with that, but we did feel that probably is a reasonable reflection, like taking into account short term, probably some pressures in terms of recession and things like that. Also some impacts from them trying to diversify their supply chain. But if we take a bullish look on a really strong product, really strong brand with and really strong sort of ability to figure out a supply chain, and we think that if they were to transition that to their services, then they should be really positive there. So we landed at 269.83 on the bullish side. Only other thing that we changed, I think, was our continuing value growth, and we pushed that up about 0.7 points there.
Okay. And then what was in your bear scenario?
Bear scenario was lower continuing value growth. We feel like we could look at it as Apple has been in this sort of aggressive growth phase for a significant period. At some point, surely that should come to an end, and other products or other competitors come in there that they've struggled with their sort of recent launch of diversifying product things in terms of the I want to call it the Oculus. I forget what the name is of the product, but they really hadn't really been good adoption on that, and their challenges with the supply chain and trying to diversify out of China was going to make it a lot more expensive for them in terms of trying to get to the same EBIT margin. So we revised those downwards, not massively, but we did. We also felt like if we look ahead, this may be sort of a political point, or depending on which administration comes in, but in sort of we feel like that tax rate that they've been paying feels very low, and at some point there will be some feels like there'll be some adjustment upwards for that. So we adjusted both of those pieces and came out at 125. So big swing in the other direction.
All right. And so where was your target in terms of your buy sell hold?
Target was, there it is. Target was slightly higher. So we felt like while growth might be slightly slower than what we had it in the as is, we felt like growth might be slightly slower, but we felt that most likely they would be able to do better on their EBIT margin. We also took into account a slightly higher tax rate, and we basically came out slightly above. So essentially, by consensus on that.
Wait a minute, how did you come up with a buy?
Just being, I mean, we felt like the model share price, we felt like the share price would be slightly higher than what our current to as is was. So assuming that's the criteria for whether or not we buy.
Our criteria is got to be more than 10% of the current share price to be.
Okay.
So it would, in that range, if it's 198, it would actually be considered a hold. So plus or minus 10% of the current share price is considered a hold. So
Okay.
you'd be,
We were just looking at net higher or lower, but yeah.
all right. How about somebody else? Did somebody else have a slightly different buy or a, I don't know, recommendation, but a bull or a bear? And if you want to share, go ahead, add a 2-2.
Okay.
And by the way, before you share, let me show one thing here. I thought in the JP Morgan analyst report, there was a tax rate. Just pulled it up again. It is right there. I gave you for Apple. Now, they had actually used 9.9% in 2024. But even though you didn't see it or couldn't find it.
That's Amazon, I think.
Was that Amazon?
Yeah.
Oh, sorry. Then never mind. But the point is, if you can't find one, I think what you did as a process made a lot of sense. So, you know, that would have been a good way of reasonably estimating it. And also what you said, even about, you know, a future higher tax rate seemed reasonable in the scenarios that you did. So just reinforcing that. All right, so back to attitude 2. Go ahead.
Okay.
What's about your share your bull and your bear? And your rationale?
Okay. This is the assessed valuation.
Okay.
The current share price is 192. The model is 192, based on the assumptions that the long-term growth rate of the revenue growth rate is going to be 5.2 into perpetuity. The EBITDA is going to be 30%, and then the continuing value growth rate at 8.02%.
Okay, and what did you use for the tax rate here?
16.5.
Okay, and where'd you come up with that?
Assuming that the company is not, I'll say it's just an arbitrary tax rate, something close to where they are in 2022, just slightly higher.
Okay, so if you go back to your G on your assumptions, you're going to have a slightly different G than what was previous presented, because obviously if your tax rate is different, the cash flow is a little bit different, therefore the ROIC is different, therefore the G ROIC combination is slightly different. So still showing a high G, but that's why you have a slightly different G than the other person who just showed. Chris. But go ahead, keep going.
Okay, and that is it. That is it for the assessed valuation. For the target, do you want me to talk about the bear and the bull as well?
Yeah, kind of talk about your bull and your bear and your rationale, just like we heard before. Hear what you had to say.
Okay, the bull is assuming that the company does extremely very well, and the bull valuation is at a whopping 289.74, and that is assuming that the company improves on all fronts, assuming that the tax rate remains the same as 2022 and into perpetuity. The EBITDA growth rate is higher than in the assessed valuation. This is at 35% compared to 30%. And this is assuming that the company is able to launch more products and innovate more, so that they, and also to get into artificial intelligence, which is a low cost, is a low cost income generating avenue. And the revenue growth rate is at 7% compared to the 5.2 in the assist, and the continued value growth rate is at 8.5%.
Okay.
That's for the growth. The bear situation is assuming that the company does not do as well as it's expected, and the valuation is at 127.84. Assuming that the revenue growth rate is going to be at 3% into perpetuity compared to the 5.2 assist. And the EBITDA margin too is not going to be as high as the assist that was 30%. And this is assuming that the company is not efficient with costs. It's not as efficient as they are currently with cost, assuming that their cost increase, so the EBITDA margin is going to reduce. The continuing value growth rate is still relatively high at 7% because Apple is considered a high growth company. So it is still high at 7%. And yeah, the tax rate will be higher, assuming that they don't have a lot of tax exemptions at 17%. And then lastly, for the targets, the target valuation is at 241. It is a buy, and this valuation is taking into consideration that Apple is innovating. They are going to continue innovating. They are going to continue introducing new products. They are going to capitalize on their existing products. Right now, they have premium pricing. They are going to continue with their premium pricing, and that the economy is going to improve. Because as the economy improves, it will reduce their cost of doing business. And the tax rate is at 16.5. The revenue growth rate is at 7%. The EBITDA growth rate is at 33%. And the continuing value growth rate is at 8%.
So what was your target share price one more time?
The target share price is 241.
Okay, so
which makes it a buy.
You're definitely into the buy range. Okay. Does somebody else have a sell on Apple? Thank you for sharing that. Did anybody else kind of predict a sell in your assignment? Think that they were worth less than 192? Or was everybody in the kind of hold buy range?
We got sort of close, but I think we're still a soft hold.
Okay. Can you share that one?
Yeah.
Stuff.
Okay, I'm stopping to share.
Okay.
Thank you.
So what was different about your soft hold? Just kind of focus on your target. In fact, you're creating your own terminology there. Soft hold.
Yes. So in our model, we assumed that this is not our original G was here in the as is case, which was higher, I think, than both other cases.
Mhm.
But we were using, again, a different tax rate, which was even lower. We assumed that would fall as geopolitical tensions forced Apple to relocate manufacturing and also close them out of an entire market, possibly. assuming they're no longer able to sell directly in China.
Yep.
We also saw the tax rate increasing in 2025 as part of the global minimum tax rate. And other than that, we left EBITDA alone. I think this is the average over this period, just about.
Mhm.
And that left us with a price target of 176.40, which is not 10% down, but getting there.
Okay. Hold this file for a second. I'm gonna want to come back to it. But what happened in Apple's earnings call? Because today they're like 170, they're actually pretty close to what your soft hold price is. I think today they ended up closing at 178. So why did Apple go down? Why did they disappoint? Did anybody read about what they talked about in their call? What happened? Adam?
I didn't listen to the earnings call, but from my readings, it looks like their PC sales definitely declined, and some analysts were saying that their iPhone sales might have peaked already, given that two of their competitors, two Asian competitors, Samsung and Huawei, they have better camera technology and display technology in cheaper phones. So I think that could be a contributing factor.
Okay. So, yeah, go ahead, Stephen.
Oh, I was going to say also the fact that their virtual reality set, which I know because I know somebody who worked on it, took a ton of resources and really isn't consumer viable. It's only sort of large scale viable since it is less powerful than a computer and costs more than all the computers I own combined. But I feel like that not taking off the way they would have liked.
Yeah. And separately, I think at a whatever it is, $3,500 price point or wherever they're talking about selling it at, it's going to be hard to get a bunch of developers to want to put a bunch of resources into something that's not going to sell much, because you're not going to get large scale consumer sales. So if I'm Adobe, like, why do I want to put Photoshop or some of the other, industrial products that I sell, put a lot of resources to convert it to that platform if I'm going to have 1,000 users? So, and how much am I going to pay for it? So yeah, that's one of the chicken and the egg problems I think Apple is running into, which previously Meta had run into, even at a much lower price point. But here's the key. I'm going to hold this sharing for a second and then come back to answer this question in a little bit more detail. When the analysts are forecasting Apple, just kind of different to what we're doing here, the one thing that they're doing is like I said, they're not just forecasting revenue as we are doing for simplicity in this kind of shorter version of the MBA class. They're forecasting each one of the segments of a company, right? So there's a forecast for, you can see it here, service revenue. There's a forecast for iPhone revenue. There's a forecast for the Mac revenue, which was just referenced here a minute ago. There's a forecast for iPad revenue, and then the watch. And so the whole point is that Apple's the sum of all of its segments. And so they're forecasting revenue for the segments, and then they're going to forecast a margin for the segments. Okay. And then they'll get an average gross margin and therefore a revenue growth rate. So in a way, it's very similar to our spreadsheet. It's just they're going to have a few more tabs because there's going to be a little bit more granularity to forecasting the segments, which lead to the revenue, as opposed to here where we just kind of forecast to the revenue. Right? But when they had their conference call, and this will play out into our valuation models, we can see how it changes the valuation. Basically, there were two things that kind of went more negative for Apple versus expectations. One was what was just mentioned, that PC sales in general have been going down, and Apple was no different than everyone else. So basically Apple's sales for their PCs shrunk. And the market wasn't, the analysts weren't expecting it to do well, but I think they even kind of disappointed there because Apple had just released a couple of new PC products, but they didn't sell that well at all, particularly their new 15-inch Air didn't sell as expected. So the point is, what I think the analysts were doing was that, and the people that were kind of modeling out the cash flows basically said, okay, if we're having disappointing sales in the PC market, maybe that market isn't growing as fast. Maybe Apple's not going to get as many sales in the future. They kind of cut their revenue and margins for Apple in that segment, which put a little bit of a downward trajectory in the company. But the one that was actually the most surprising was iPhone sales. Is that iPhone sales came in lower than expected. And I don't know who on the call said it, but I remember reading the summary of this. But the idea is that Apple basically admitted that for the last 2 quarters, the global smartphone market has declined, and they were not immune. So basically, their iPhone sales declined because people were just buying less smartphones, and they were not gaining share against everybody else. They just kind of went down as the market was starting to go down. They're having trouble selling phones because it's just a really tough environment out there. Now, we can talk about whatever the macroeconomic reasons are, but that's why an EIC is important to do, because Apple, as it turns out, is not immune to some of these external factors. And so the market for smartphones has come down. And so again, 2 consecutive quarters declining market size, Apple selling less smartphones than anticipated because of that. And then the question goes forward, ... Right. So it goes forward into, if we're doing a valuation, all right, the next iPhone's coming out in September. And that's, you can see, of their revenue, 205 billion out of the 316 billion last year was the iPhone. So it's their most important segment. What's going to happen to iPhone sales? And you can see right there, look across. What is the expectation here? If this is the average of the analyst guess of the segment.
$5 billion revenue drop.
Yeah. They're not expecting the iPhone 15 to basically be the huge success that Apple would probably like it to be. Because it's not that it's not a great phone, but I think that there's 2 headwinds that they're worried about with Apple. One is the market, and part of the market is people are keeping their phones longer, and they're not buying as many of the higher priced phones. I'm not saying they aren't, it's marginally, but they're not getting the growth because the market is going to be sluggish. Apple's facing this sluggish market, and that just becomes a headwind challenge on their biggest product in terms of sales growth. And then the other thing that's starting to change is, okay, well, if we're not selling as many phones, and which is our highest margin device, we're selling more service revenue, which is more margin, but basically these other products have a little bit lower margin, including the watch. What happens to Apple's gross margin? Okay, so yes, our revenue growth is here. We're forecasting top line mix of all this, but this is the gross margin. Okay, gross margin 44%, 44%, 44%, 44%. Okay, operating margin 30%. Right, so 44% gross margin, 30% operating margin, adjusted slightly down because of lower iPhone sales. So whoever was just sharing, put up your model for your target, the one that had the 270 something model, and go back to your ratios tab. Make it a little bit bigger so we can see it. Thank you. So what EBIT margin do we have in there? And what gross margin? We're not really directly forecasting gross margin, But what EBIT margin are we forecasting?
Sorry, I was muted. 30%.
That's
in
EBITDA, yeah. So we're 30% EBITDA and 27% EBIT. But the whole point is, when you start getting closer to a 30% EBIT margin or slightly lower versus where they are right now, which is last year they were 33%. Looking at G, whatever that row is, 33% EBIT and 30%, 33% EBITDA, 30% EBIT. And the whole point is, if that starts trending down a point or two, which is essentially what you're showing here, you're showing a declining EBITDA margin, just proxy, right? In the cash flow valuation. And when you're showing a slightly declining margin on sluggish sales, so your sales are probably a little higher than Apple sales, then what you end up with is a lower share price. That's why their share price fell, right? Because basically two things happened. That granular, particularly the iPhone, less iPhones led to less revenue, so lower growth rates slightly, and slightly lower margins because the product mix was shifting towards a lower price point. Now, even if it's a few basis points, it starts to matter at their scale, but that's why their share price fell last week. All right, and you can actually see it and you can model it out in the marketplace, in our model. But that's the point. Like they, in a way, if I put it back at a 30,000 foot point of view, Apple's trended a little bit more towards the bear scenarios that you guys outlined than the bull scenarios. And unfortunately, or fortunately, when we do modeling, we use the kind of short term to help us infer long term. So if they're missing now, the analysts think that they're going to continue missing later, as opposed to a, kind of like a puddle. It's not like you're walking down the street, you just step in a puddle and everything is fine. They think if you kind of walking down the street, you're hitting a stream. You're gonna have to go past, as opposed to the puddle that you'll walk through. So that's the problem, is right now that the longer term is being slightly jaded by the short term. But that goes back to EIC. I think right now the market's worried that their biggest product is now entering a more mature stage. And it's gonna be harder to grow. And the last 2 quarters, are trending in that direction. So that's the question. The real question for Apple is, was that a blip? And then they're going to be back on a growth trajectory? Or is that the trend? Because as you just said, those other segments outside of services, like, I don't think the VR headset looks like it's going to be a giant hit anytime soon. So if iPhone starts to struggle, what's going to be the biggest growth driver outside of services revenue? So I think those are the real questions for clouding Apple right now. But nonetheless, over the last week, it has put them on a slightly lower trajectory. And again, I think the next catalyst is going to be in September when the iPhone 15 launches. And the analysts are going to be looking very closely at those orders. So whatever their date, September 13th, 14th, whatever day they're going to launch, the pre-orders come out that Friday. And then the following week, I think they start delivering how many orders they get, and they're going to comp them versus their expectations in last year is actually going to be the next big driver of Apple stock price, because it's reading the tea leaves of whether or not they're going to be able to get the growth of the iPhone back, or whether this is really kind of like a secular decline of the maturity of the marketplace. So, and you can see that as you play through the scenarios of the marketplace. Now it's just one level deeper than what we heard initially, but that's kind of where these models tend to go. Questions, comments about any of that? Thoughts, concerns? Want to add to it, subtract from it?
It would,
Yeah, go
sorry.
ahead.
When we're making a model, we had added a situation that increased revenue starting in like 2024 by a little bit, like just $1 billion a year. I mean, that's a lot for a lot of people, but not a lot for Apple.
Yeah.
Is that kind of good practice, or is it best to really just keep changes to the 2028 into the future scenario?
I mean, the best practice would be to do the individual years and the perpetuity period to be as realistic as possible. But the point is, even for a company like Apple, and you could joke about $1 billion because to them it is a rounding error, but if you go to the DCF valuation tab, whoever's got the screen up. And scroll to the left to make it a little bit bigger. Look at the continuing value. Look at D, one more over so I can see the whole thing. See the rows, the row numbers.
Oh,
Do I have the row numbers or did you hide them?
they should be there. I don't know why they're not.
But anyways, if you look at continuing value, which is like 2.374 billion, there it is, row 9. Look at D9. Okay. And then look at, I don't know, D4. So add 1 billion to D4. How much is that going to change the value of the company compared to the value that's being reported in the continuing value period? Because that's the point. If you add 1 billion of cash flow to a single year, then D4, let's just say, goes from 74.5 billion to 75.5 billion. That's going to add to their operating value in the first 5 years, 365 to 366. I mean, it's going to barely move the needle of the real stock price of the company.
Yeah, it wound up being like a 0.25% change or something like
Yeah,
that.
exactly. We got 4 billion shares or whatever they have. How many shares they have? It's 15 billion. So it's going to have a tiny impact on their share price. But if I take a perpetuity billion every year forever, even at a 10%, take 1 billion in perpetuity at a 10% hurdle rate, billion divided by 0.1 is a $10 billion impact. So it will have a much bigger impact in the perpetuity period than it would in any single year of the defined value period. But the real point is I want to be as accurate as possible. So I don't want to just, arbitrarily put it into the perpetuity period. It's kind of what we're doing in this class for simplicity. I'd want to do it year by year. But even if you're doing it year by year, for any company, the perpetuity period is going to matter more. So getting that one right is critical to understanding the real value of the company. Adam?
So, Professor, do you think that the analysts maybe are too bearish on Apple, or do you think that they got it right with their new stock price?
This is an opinion, it's not research-based, but in doing this class for 15 years, I think the analysts have trouble looking more, and the Wall Street in general has trouble looking out more than 2 years.
And kind of my thought process as well is, you mentioned that the new iPhone is going to launch in September. What things would you as an analyst be doing between now and then to kind of ensure that you have an accurate forecast?
Well, I mean, right now, there's two sides of the forecast. They're looking at what Apple is doing and how much they're manufacturing. And I'm sure they're trying to figure out through the supply chain, essentially what's Apple's forecast by how many supply chain orders are out there. And in a way that they're assuming that Apple knows a little bit about the consumer. And so they're going to be, creating the amount of volume that they think will sell. But that being said, they're probably looking at Google and the Pixel, and they're probably looking at Samsung and their sales. And that's the problem, is when you start triangulating that, that's kind of what hit Apple on the conference call, is that Google's having disappointing sales, Samsung's having disappointing sales for smartphones, particularly at the high end, and Apple just reported 2 quarters. So that's what I said. I have a feeling, because now we're predicting, they're just going to take a very watchful eye to what Apple's actually reporting over the next few weeks, and then infer over a long term, because it's almost like the leading indicator for the next 12 months is what they get in the first 14 days.
Mm-hmm.
So
okay, so you think there's a good chance within the first 14 days on whether you know if Apple lost its product leadership position?
It wouldn't be leadership. I mean, they're still going to sell, and dominate the market. It's just whether they're growing at 3%, 0%, or negative 2% is going to have a very big impact on Apple's share price, as you saw here. That's the bull scenario started heading towards the 176 for their target. And it didn't take long for Apple to go back to 176 in the real, or 178 in the real world, when people looked at a slightly lower trajectory of iPhone growth. So, that's where the short run comes in. But that's the other part, is that, Warren Buffett would say, who cares what happens in the next 2 weeks? If Apple's a great company and the market still looks strong, you can still model out a longer term that this is a blip and they head towards that bull scenario. But I think that it really boils down to two questions. Question one, what's going to happen in the smartphone market, which is their biggest product long term? And are we really just getting to a point where it's now a mature market? And so if it's a mature market, it doesn't matter who you are, it's going to be hard to grow. And so therefore growth is going to be a challenge for Apple. And then number two is, do other products usurp that? So as smartphone mature declines, think about a PLC over time, next 5 years, what replaces that to put Apple back on a growth trajectory? Right now, their biggest growth product is services. You saw it's like $80 billion business and very profitable. But if this iPhone goes down, the services start to slow. Those are questions that you got to try and figure out as an analyst, because that's going to affect Apple's value. And then they have a what's next. And right now, I don't see a what's next. I think the market does. Like, what's their next big product? It's clearly not the headset. So,
Professor, why do the analysts, I feel like they place a lot of weights on the earnings calls, which is probably fair enough. But like when we did like our EIC analysis and we're looking at like the industry and where that is, surely there should, like, the saturation or the maturity of the market like gets built in there. Obviously the numbers are really the measurement, but it just feels like they're surprised by what came out in the earnings call rather than like having a feel for that being where it should be.
well, again, it's not unanimity in one direction. There are still some analysts very bullish, a couple bearish. I mean, even if you look at Apple's buy sell holds, they're all over the place. But the point is, again, I think practically people are a pebble in a pond. Is that you throw a pebble in a pond, the waves get bigger the further out you go. So, right or wrong, we look at short-term indicators to infer long-term, just kind of like inductive reasoning. And that's what people do, for better or for worse, that's what they do. So again, if you are looking long-term and you can get a better view of something, you do want to triangulate that, right? I'm not saying the analysts are ignoring that, but I'm just telling you, when you kind of read the tea leaves and any product is going to go through a product life cycle, Apple's not immune to that. The iPhone is not immune to that. Smartphone is not immune to that. And that could be what's happening in the marketplace, is that, we can't just get ever raising prices at the high end of a growing market. And so that's the point. Like, is Apple going to have to start, instead of, we get to the new iPhone 17, it's like, it's not Apple raise the price $100, it's Apple cut the price $200 in order to keep demand going, because it can't keep raising their price and getting more sales. I think those days we're going to look back on and wonder whatever happened to them on a go-forward basis. I think it's a reasonable expectation. And that's not just Apple, that's any company. That's why I go back to what you read in the McKinsey book, talked about regression to the mean. No one is immune to regression from the mean. So in a way, that's what this conversation is about. Is Apple going to start regressing towards the mean? No one's going to maintain a 600% ROIC into perpetuity. Ain't going to happen. I don't care how good you are, right? So when does that competitive advantage erode? When does that market start to mature? I think that's where the market has angst about right now. How long before that happens? It's going to happen. And that's where the valuation will play. If you look at a different company like Amazon, the one thing about Amazon is they have multiple growth vectors. They're not just one product, right? So they got Amazon Web Services, which is growing dramatically. They got their e-commerce business, which is growing dramatically. They're now in healthcare, which is growing dramatically. They're going into groceries, which is, for them, growing semi well. They're reorganizing their business to grow more efficiently, but still a giant market that even a small share gives them a lot of growth. Like, they got multiple vectors for growth. So no one's worried that Amazon's growth slowing in the next 3 years. Apple's got the iPhone. And then once that iPhone goes away, what's next? And that's at scale when you're a $300 billion company. And that's the thing. Outside of services, Those other products aren't going to replace the iPhone. But nonetheless, that's what we'd have to think through and model. If we really kind of want to get into detail about any company. Other thoughts, questions about this? Make sense? I'm going to add to this.
Just noticed, Professor, that you seem to be right about Amazon. It seemed to pop up after their earnings call.
As I said, past performance is no guarantee of future performance. And I wasn't advocating buying Amazon, so didn't go out there and spend your own money. But so what happened with Amazon? So let's talk about that for a second. What did happen with Amazon?
I didn't dig too deep, but I noticed they were up like at least 5% after their call. But I don't know why.
Well, first part is down a little today, but I think the market was down today. I mean, if you looked at Amazon, and again, I go here to the company specific parts of their business, which is what I was kind of talking about. But, you know, every one of their segments is expecting growth. And so that was one thing that Amazon talked about. And I think the other thing that Amazon talked about in their call was that they're getting slightly better margins for this growth. That basically whatever the new guy's CEO is, forgot his name, Jay something. So what is his name? Jassy? That Jassy, the new CEO, has been controlling costs. So Bezos' philosophy was, build out the business, don't really worry as much about margin, get the revenue. Now Amazon is actually getting a little bit more revenue, and that's what you see here, but they're also getting more profit for the revenue. So, just looking at the EEO screen, what these green arrows mean is in the last 30 days, the average has gone up. So coming out of the call, it wasn't just that the revenue was higher, is the profit for the revenue was higher. So for example, in 2026, the average has gone up in terms of operating profit by almost 13.7 billion by the average of the guesses. So that's 21% higher operating profit in 4 years than what the analysts had thought before. So I think back to Pebble in the Pond, they're getting more profitability out of those businesses. And when they reported that as a earning surprise, so if you go back to the quarter, this was forecast. So what did they come up with? They came up with a positive revenue beat, 3 billion higher, but more importantly, gross margin was 48, analysts expected 46. And so that was the point, like they're getting better margins at slightly higher growth. So if you assume that they're able to maintain that, then in a model like the one that you guys just had, you could now we would just put up our EBITDA margin a little bit, but what the analysts would do is they would update their gross margin a little bit, which would drive a higher EBITDA margin, which would drive more cash flows, which would drive more value. So that was kind of the difference between what happened with Apple and what happened with Amazon. Okay, so Amazon was actually reporting better cost control on their revenue. Apple was reporting a little bit worse revenue for their highest margin product, which is essentially lowering their margin slightly going forward. And that's where you saw the differences in the way that the stock prices reacted. Now, obviously, more information will come out in the future, but that's at least how they're thinking about the future and how the models would be adjusted. Questions, comments about this?
I have a question. Looking at Amazon, when you showed the company, the segments, the company specific information, even though they are all growing, but the rate of growth is declining
Yes.
for some of them. What does that indicate?
Well, the first thing is you would expect it as you get bigger because don't forget that there's something called the law of large number effect. That as you get bigger, the percentage changes get smaller. So for any company, as they scale up, those percentages have to come down, right? Because when you're a $70 billion company, which is still pretty big, growing 10% is $7 billion. When you're a $700 billion company, growing 10% is $70 billion. So I'm just saying, you know, number one, the percentages are harder, but number two, like, think about that. Amazon has to grow, you know, 70 billion a year at the size to get 10% sales. That's not as easy to get to. Like, you know, think about that. There's many companies that don't have $70 billion period in sales, and Amazon's gonna have to do that in 1 year. So the percentages just will naturally over time start to come down. So you shouldn't be surprised about that for anything.
Okay, I guess what I was thinking is that could that be an indicator that the high growth space is getting to the end of the high growth phase? Or
Well, but think about your question in a different way. If you're gonna have high growth, where's the high growth gonna come from? If any company's gonna have high growth, where is that growth gonna come from?
mostly from revenue and
For revenue. but
ultimately
where
from
does that
profit.
revenue come from? I mean, conceptually, it's gonna come from one of three things. Where's the growth gonna come from?
From revenue,
Yeah, where does revenue growth come from? How to get more sales?
yeah,
Yeah, Adam.
Selling more products or services,
So how does that happen?
R&D,
Well,
or if you're acquiring another company that has positive ROIC.
so I'm saying, I'm thinking macro.
Multiple ways.
Bigger is what you just gave the third one. You can go buy. I can go buy revenue, buy another company. Okay. But organically, what's the other two ways to grow? So one way I can grow is I can buy revenue. Second way I can grow is my market grows. So if I'm in a market that's growing, it's easier to grow. Third way is I can take share. I can take customers away from you. So if you really think about it, those are the three ways you're going to get revenue growth. You're either going to get it because the pie is expanding. You're going to get revenue because you're taking a bigger share of the pie, or you're going to get revenue because you go buy somebody else's pie. That's it. There's no other way to generate revenue. If you really boil it down and distill it down, it's going to be one of those three buckets. So the problem is for Apple, the conversation is in that context, their pie is not growing anymore. So if Apple wants to grow and the pie is not growing, how do they grow? They got to take share from somebody else, right? Or they're going to go buy somebody else, right? Now, Amazon is in a different state. Amazon's pie is still growing. They got several pies that are growing. So they don't need to take any share to keep growing because their markets are growing. They're just in a different trajectory than where Apple is. But fast forward at some point in time, data center revenue is not going to keep doubling. That's not going to happen forever. So at some point, Amazon Web Services is not going to grow nearly as fast as it has in the past. And so therefore, it will be like Apple's iPhone today in a few years. Same thing with other parts of their business, if that makes sense. So that's the point. Like Amazon is growing, but they're not going to grow forever. Nobody does. That was quarterly revenue. Back to annual revenue here. Kathy?
So when looking at your actual versus estimated, what I saw is like the net adjusted income that they reported was almost double for Apple. Isn't it kind of surprising that their stock only went up 5% based on that?
Well, again, that's just, if you think back to our DCF, that's just for one period. It's not the perpetuity. All right. So again, yes, it went up and then I adjust my margin up slightly. So my perpetuity value goes up. But just like Apple, you know, the one period, given Amazon's almost, how much, what's Amazon worth? Given that Amazon's worth, so market cap, $1.4 trillion, you know, making an extra $1 billion doesn't move the needle of their stock price, right? What moves the stock price is the long-term modeling for the size of the
Right.
company. But that was the point. That the long-term modeling, and you saw it in the EEO, all the arrow ups going out over the years, modeled up higher cash flows, which modeled up a higher share price. That's why the institutions were willing to trade at Amazon at a higher price. That's the link I want everybody to make sure they understand. All right, so let's put this one to bed. Any other questions about your Apple assignment, or what's we need to talk about with our bulls and our bears and our targets, and some of the analysis that we should at least be talking about as our rationale for changing things? All right, so then what I want to do is go to a related topic, which is that of multiples. Okay, and this will be our fourth and final topic for the semester. And I did, I'll go back to our lecture notes. I put up a lecture note 4, which we're about to cover. And there's some readings for this week. And also in our files online, I want to point out something. Somebody mentioned this in the chat, but actually for the Apple tax rate, in their guidance, they had guided 16%. So if you had actually looked at the guidance screen that we had, you probably should have used 16% in your model. But if you use the numbers that you did, I can't say that your rationale for using the numbers you did were wrong. Meaning analysts don't always take the company guidance because that's usually shorter term guidance. And what we're trying to understand is infer a long-term tax rate. So I think both people who presented the tax rate earlier, that's why I didn't really question it too much, that they had reasonable rationales for why they use tax rates that seemed about what Apple was saying they would be paying. Now, if you had suddenly said 30%, then I would have probably, started asking, like, where'd you get that number from? But I think if nothing else, 16% was the guidance from Apple, just a separate point. So slightly lower, slightly higher G to some degree that you would have gotten your model if you'd use that. Back here in files, a couple things. One, I put here in team project data. These are your 5 teams. And in each of the folders, I've started putting all of the data to do your group project assignment. So here would be screenshots that you did for your last assignment and the screenshots for your EIC assignment. And then the data for the valuation multiples will be in here shortly after tonight. And so basically you'll be able to use what we've been talking about on your group projects, okay, including doing the valuations. So that's where you'll find the data for that. And as I said, under lecture notes, we're about to go through lecture note 4, getting into the multiple analysis, right? But mixing metaphors again, for your team project in 2 weeks, okay, the entire class will be the team project. All 5 of you will present, and you'll have about 20 minutes to present. And for each of those companies, let's take Disney, you'll go through all 4 sections. So you'll have to have a PowerPoint with supporting data that basically says, all right, here's their historical EIC for Disney, right? Walk through that. Then you're going to go through the historical ROIC tree and CFI for Disney. Walk through that. Then you're going to have to go through the valuation for Disney, as is bull, bear, target, your buy, sell, hold opinion. And then you'll have to do the multiples analysis, which we're covering in class today and next week's assignment for Disney. That's your 20 minutes. So approximately 5 minutes of PowerPoint presentation time for each one of those sections. 20 minutes total to cover all 4 sections that we're doing in the class for the projects that you were assigned. Okay. Now, next week, as part of your grading, one team will be assigned to evaluate your presentation. Okay, they're the analysts that you're kind of presenting to. So at the end of your 20 minutes, you will have Q&A. That Q&A will be led by that team. So I'm not going to be asking the questions. I'm going to be observing, right? So for example, Home Depot might be the team that's evaluating Disney. So at the end of Disney's presentation, the members of Home Depot have 10 minutes to talk to the Disney people, ask them questions, and grade their assignment. So each of you will be assigned one other team to be their Q&A and to grade them. And then submit how you think that grade is to me. Okay. And so you will help me give final grades on those presentations. So you'll be delivering a presentation for a grade, and you will be essentially peer reviewing by asking questions of the team in real time and giving your own input on their grade for their team presentation grade. That was what was originally the syllabus. So just an FYI on what's coming up in 2 weeks. That's our final class. Somebody said, will the income statement and balance sheet be added for group projects? Yes. So what's coming up next, either tonight or tomorrow morning, is I'll add in the Excel data with the raw income statement balance sheet data, and then all the data for the multiples. So you'll be ready to do your valuations as well. All right, questions about any of that? So that's 2 weeks from tonight. All right, so back to today. Let's talk about multiples. Lecture note 4. All right, multiples, also known as comparables or comps. Basically, the idea is they look at prices in the real world to come up with a valuation. What I've told students for years is you've probably run into a multiple if you've ever bought a house, okay? Because the appraisal on a house is a multiple analysis, right? Because what you're going to do if you buy or sell a house to get your appraisal, it's what the appraiser is going to do is they're going to look at basically similar houses in the last 6 months that have sold near your area. And what they're going to have is a list of all the sales prices and essentially the size of the houses in square feet. And then they're going to divide. And they're going to take revenue per square foot, price per square foot. Okay. So let's just say, making numbers up, you have a 2,000 square foot house and the average house is selling for $500,000. You take 500,000, you divide it by 200,000, and that would get you, what's that, $250 per square foot. So basically you get a price per square foot. And then you multiply by the square feet of your house based on what the average price per square foot of the house is. And that starts the starting value for your appraisal. And then what the appraiser will then do is he will just, or she will just adjust that price per square foot value up or down slightly based on your house. So do you have the same lot size as other people? Well, if you've got a bigger lot, maybe I'll give you a little bit more price per square foot. I could figure that out. Do you have, are you in a better school district? Do you have the same number of bathrooms for the same number of bedrooms? What's the age of the house? What's the condition of the house? Things like that. So we'll adjust it up or down slightly. But the idea is they'll infer, based on what other things have sold, a value for you. That's essentially what a multiple analysis is. And we're going to do the same thing with companies. So the general idea is they start with prices and work backwards, right, to figure out value. It's a relative valuation based approach. And what's useful about this type of an approach is that not only can it be used to value public companies, but you can use it to value private companies. Because you say, look, if I were trading publicly based on what similar things are trading at, this is what I should probably be trading at. So you look for similar things to infer that value. It's also used for acquisitions. And so that would be another thing. Like, let's say I'm going to buy another company. Well, what have people purchased other companies for? Matter of fact, just to give you a sense of this, here is an M&A database. And in an M&A database, you can see, let's take an acquisition that was announced recently of any real size, nothing today. All right, here's one. Symphony is buying a company called Avid Technology for $1.4 billion. That was announced today. But the point here is I can go here to the deal comps. And so very quickly, what I could do, and this is what my bankers would probably do, is I'd look at all the types of, I assume this is like a software acquisitions, all the recent small software acquisitions that have been done the last 5 or 10 years. And then they'll basically look at the price paid, and they'll look at some financials if the company had them, like total value of the deal to EBITDA, total value to EBIT, total value to revenue, total value to assets. And they'll basically get not only the multiple for each of the deals that were paid, but they'll get an average deal. So the whole point is, for small software companies, generally over the last 10 years, let's just say 2014, 9 years, the average deal price to sales ratio is about 6. So 6 times revenue is about what these deals go for. What's this one going for? And then we can basically come up with a price, and then should it go for 6 times revenue, we'll adjust. But nonetheless, whether you're a public company or a private company, you can actually use deal comps as well as a form of valuation. So there's multiple ways of doing it. So back to the concept is that the key when you do this, which we'll be talking about, is to find things that are truly comparable, right? And that sounds easy, but that's actually the most difficult part of the process, is figuring out what you really want to compare to and who you should be comparing to. And then essentially what it also should give you is the idea of a trading range. Just because same concept of the buy, sell, hold, we should have a range of what the company should be worth, as opposed to an absolute amount, but nonetheless, comparables help us understand what that range could be. So the steps, or sorry, the challenges with multiples are the benefit of the multiple, meaning multiples are simple, they're easy, right? Because, and what you'll see in just a minute, is they're kind of based on the key value drivers. They're really just a few numbers that are inferring the entire value of the company. So they're easy to do because they're also based on public data, but that's their limitation because it's oversimplifying. Like a DCF, we get pretty granular about what's going on with the company. With the multiples, you don't really get granular, right? And so therefore, it might overlook some of the challenges of really understanding what's going on with the company's value. And because we're oversimplifying it, that's just back to the challenge of multiples. We're using a broadsword here. We're not using a scalpel, right? But theoretically, a multiple analysis and a DCF analysis should still give us the same answer. That's what's important to understand in the approach. So what is the approach? First, step 1, find peers, find reasonable peers. And as the book talked about, one of the key points for reasonable peers is not just that they're in the same industry, but you want companies that have a similar operating and financial profile. Meaning, if I'm valuing Meta, which is Facebook, which is a big company that's about $160 billion in revenue and established, and then I have another company who is a startup in the social media space, just because they're both in social media don't mean that they're actually comparable. So I wouldn't take a social media startup and compare its multiples with Meta's multiples, right? That's an apple and an orange. So I still want to have companies of similar operating characteristics, right? Similar growth trajectories, similar, margin type profiles, as opposed to in similar stages of the life cycle. So even within an industry, not all companies are truly comparable. Now, unfortunately, for simplicity, we may not be able to do that. And we might actually use the industry, but it's just a limitation of multiples. Another one is that the companies themselves may not be as comparable. So for example, let's say you're looking at Lockheed Martin versus the newly renamed RTX, which is Raytheon Technologies. Said, all right, I'm going to compare those two companies. Well, Lockheed Martin is a defense company. Almost all their business is defense. When you do RTX, half their business is defense, half their business is commercial airlines. So I'm comparing these two companies, but they're not as comparable as they look, because RTX, their defense business, looks a lot different than their commercial business. And so I'm comparing an apple with a watermelon, right? It's not a direct comparison. Yet people put RTX and Lockheed Martin on comparable lists all the time. Matter of fact, same thing. I'm going to compare an RTX against, take another company, an Ingersoll Rand, right, which is a manufacturing company. Well, Ingersoll Rand, yes, they have manufacturing. They also make golf carts and they make locks. So I got a lock business, a golf business, and a manufacturing company. And I'm comparing that against the manufacturing assets of RTX, but RTX has that defense business. Like, you can start to see how very quickly it's hard to find comparables. That's why analysts like companies like Costco, because they just do one thing. And so they're pure play, they're easier to understand. And the idea is I want to compare them with other pure play retailers, but that gets more difficult because some retailers are not pure play. Another good example, this is Disney. Like, who do you compare Disney against? You could compare Disney against Netflix, okay? But Disney does more than streaming. You could compare them against Comcast, because Disney has Comcast and Comcast both have theme parks, but Comcast has a big cable business that Disney doesn't have. And so when you start looking at these comparables, that's what makes comparables a little bit harder, because companies aren't as pure play as you would expect them to be. Adam?
Regarding your question about, or you mentioned you wouldn't use a social media startup to compare against Facebook, but would you ever mix time periods when doing multiple analysis? So looking at a tech or looking at a startup in social media today, would you compare it to, post IPO Facebook?
I'd say you can't, and people might reasonably try to do that. But if you're trying to look at today's values, you probably want to try and look at some similar things that are trading today, because even if you look at a time period, 2 years ago, hurdle rates, cost of capitals, and therefore multiples were far different than they would be in 2023, because the environment was different. So if I took a company that was starting up in 2021 and even a company that's starting up in 2023, I'm not sure that they're as comparable in terms of the multiples that they would trade at, because today they're going to trade at lower multiples than they did 2 years ago, just because the hurdle rates are higher. So in theory, your point is correct. Like, I can kind of say, all right, well, what was a Facebook trading at when they first went public? What was a Google trading at first went public? But I also have to remind ourselves that those were different worlds. Which gets back to why multiple analysis are harder than people think they are. Because it would be easy to say, oh yeah, I'll just use Meta's, early stage multiples to say this is probably what a company should trade at. But that's oversimplifying. That's what we do in multiples. We tend to oversimplify. So we have to recognize the limitations of the approach that we're taking. Other questions, comments about this? All right. So once we select our company list to compare against, then we go get the data. And that's why a data service like Bloomberg, which is what we're going to be using, is easy. But there are other data services as well. But the whole point is you need to go get your data. And then step 3, calculate the multiples, which usually the data services do for you. Now we're going to do it 2 ways, because we're going to triangulate, because we're also going to estimate what the multiples should be using the academic formulas. And then we're going to basically benchmark and see the differences. and try to explain and understand the differences. Why are multiples different amongst the companies? So, few best practices. Number one, ideally, choose companies that have similar prospects for ROIC growth. That's kind of your rule of thumb, even more so than the industry. Number two, we're going to use forward-looking multiples, not historical-looking multiples, because companies are worth the sum of their future cash flows. Therefore, forward multiples are better estimates of cash flows than historical multiples. Right? And specifically, we like clean forecast years, meaning when we started building out our valuation model, I mentioned that, 2023 for many of the companies was half actual, half forecast. I said, well, that's not as clean as a company that has 12 months of pure forecast, which would have started in 2024 for many of the companies we value. So that's the same idea in multiples. We tend to want to use future multiples that are based on clean 12-month forecasts. And then finally, we have to be careful with multiples, because if a company has a lot of non-operating value, like Apple, right, or some one-time gains or losses that are affecting their earnings or numbers, then that might have an impact on the multiples, and we might need to adjust for that. Okay, so those are some best practices to be aware of. Again, I mentioned this before, but multiples can also be used for precedent transactions. Think M&A, or something that's happened in the past. All right. For purposes of this class, we're actually going to focus on 3 multiples. Okay. We are going to focus on PE. We're going to focus on enterprise value to sales and enterprise value to EBIT. Okay. I'm not saying we can't look at enterprise value to EBITDA, but for simplicity, we're just going to start with those 3. PE, enterprise value to sales, enterprise value to EBIT. Multiples are based on key value drivers. So here's what I really want you to understand. Using the key value driver equation, okay, we're going to put in some numbers. So we're going to start with 100 million of NOPLAT. We're going to have a 10% WACC, 10% cost of capital. And then we're going to plug in growth rates of 1, 2, 3, 4, and 5%. And we're going to plug in ROICs of 6 through 16%. And we're going to basically say what value is spit out by the key value driver equation. And that's what's placed here on the table. Okay. So basically, and just to remind ourselves, that's the key value driver equation. Okay. So basically just putting those values and creating a table of the results in that equation. That's what that is. Okay. So if we have 100 million in NOPLAT, 10% WACC, 10% ROIC, regardless of the growth rate, 1 through 5% G's, we'd have $1 billion worth of value. Okay. If we have less than a 10% growth rate, or sorry, less than 10% ROIC, so think negative spread, these would be the values. And if we have a positive spread up to 16%, these would be the values at these different growth rates. All right. Why are the values going down in this column? Why does it go from 926 to 333?
Because if you're growing, but you're making less money compared to the cost of capital, your hurdle rate, you don't want to be doing that.
Yeah, and you can see the impact of that value destruction as we accelerate the growth. Whereas the value creation, as we accelerate the value of the growth, we have a positive spread. Okay, so this is positive spread, negative spread, break even spread. Okay. Everybody clear on the table? All right, here's what matters. This is a multiple. So how do we do a multiple? Well, what we do is we say, okay, if we had 100 million of NOPLAT or NOPAT, and let's say the tax rate was 35%, then our pre-tax profit, our EBIT, would be 154. And this is kind of taking 100 divided by 0.65. So here's the idea. What's an enterprise value to EBIT multiple? Well, this is our enterprise value based on the key value driver equation, 1 billion. And we had 154 million of EBIT. 1,000 divided by 154 is 6.5. So this company would trade at 6.5 times EBIT. Okay, what is 926 of value? Right, divided by 154. Well, that's 6 times EBIT. This number right there. Okay, so multiples are just your profit divided by your EBIT, or sorry, your value divided by your EBIT, and the value is based on the key value driver equation. Okay, so what does a trading multiple in this circumstance of 6.5 mean? If a company is trading at 6.5 times EBIT, what does that mean? They're in this column. What can we infer? In this column, what can we infer? Companies trading 6.5 times EBIT. Adam?
Would it be that either their share price or their value would be 6.5 times their current EBIT?
That's exactly what it means. But what else can we infer from the key value driver equation about that? About that multiple? Why did this value stay at 1,000, at 1 billion across the different growth rates?
Is it because that's their cost of capital?
Correct. So what can we infer about a 6.5 times EBIT? That the company is what?
That's their WACC.
That their WACC what?
Their WACC is 6.5.
Yeah, the WACC and not that the WACC is 6.5. The WACC is 10%. That was an assumption in the previous slide. But the spread is 0. 6.5 times EBIT is a 0 spread. That's what I want you to understand. Because that's the whole point. The reason why this value didn't change as the growth improved is because we had a 0 spread. ROIC equals WACC. So the whole point is same concept. Why this stay at 1,000? Why is this staying at 6.5? 6.5 times EBIT is a 0 spread. So my question as a follow-up is, we have a company in this industry that's comparable, it's peer, that's trading at 6 times EBIT. What does that tell you? I'm going to show you on the chart. Where do I see a 6? Here's a 6. And somewhere in here's a 6. Okay. So a company's trading at 6 times EBIT. What would that tell you? Add a 2.
It means negative spread.
That first observation is they probably are trading in a negative spread. If they have less than 6.5 times EBIT, if they're 6 times EBIT, they're probably a negative spread. Because that's where the answers would be. That answers that red line. What else could we infer about the company? What could we infer about its growth? And what can we infer about its ROIC? Trading at 6 times EBIT. What could we infer about their G? What can we infer about their ROIC?
Their ROIC is less than 10%.
So what could it be? Let's say the ROIC is 8%. What kind of G would they have?
2%,
Let's say their ROIC 6%. What kind of G would they have?
1%.
So tell me about their ROICs and their Gs.
It's between 1 and 2% in terms of growth, and then ROIC is between 6 and 8%.
That's why I told you, good answer. That's why I told you earlier that multiples are more about ranges. Because there are multiple answers to a 6 times EBIT. I can have different growths and different ROICs to get to 6 times EBIT. I can have different growths and I can have different ROICs to get 6.5 times EBIT. So when you start with a multiple, as opposed to a DCF, right, or even a DCF, the idea is that your answer is more of a range than an actual number. But I could still get some additional insight to say the range in this circumstance of 6 still suggests a negative spread. Okay, it could be more or less negative depending on the G, but that's the point. 1 to 2% G, maybe 3, 6 to 8%, somewhere in that range. ROIC is probably where this company is going to trade. Adam?
If it's a true comparable, couldn't you also make the argument that the company could be undervalued? It'd be a good buy.
Well, I want to come back to that question in 1 second, because I hate when people say that. So hold off on that question if you don't mind. I tell you, a company's got a 7 times EBIT. What can we infer for that?
Their ROIC is in the range of 11 or 12 to 16%. And their growth is in the range of 1.5 to 3.5%.
Yep. So we got a range of ROICs and growth, but what can we say about their spread? Company trading at 7 times EBIT in this industry.
Positive spread.
Exactly. So company trading at 6 times EBIT, negative spread, 7 times EBIT, probably a positive spread, 6.5 times EBIT, break even spread. I can make those assumptions. Everybody with me so far? All right, I want to go back to that question. Companies trading at 6 times EBIT. Are they undervalued? And shouldn't they trade at, if the industry's trading at the average, let's say the average in the industry is 6.5. This is average. Right here. The big A for average. And my company's trading at 6. Am I undervalued? If all my peers are trading at 6.5 and I'm trading at 6. Add a T2? Add a T2, sorry.
I would say not necessarily, because it depends on company specifics to
Well,
determine if they are undervalued.
let's say that the company that's trading at 6 times EBIT has a 1% G and a 6% ROIC. Is it undervalued?
Not
The 6 times EBIT
necessarily.
company is at 1% G and a 6% ROIC. Is it undervalued? If the rest of the industry is trading at 6.5.
I would say it depends on other factors that we can compare that company to.
How is the company that's trading at 1% G and a 6% ROIC, how are they mathematically going to trade at 6.5? What would have to happen?
To have a higher ROIC.
They'd have to have a higher ROIC. So that's the point. They're not undervalued. If you see a company that has a multiple, it's going back to the first question that was asked. If you see a company that has a multiple below average, and you say, how do they get to average? They have to improve their growth ROIC combination to get to average. Otherwise, they're going to continue to trade below average. So you're not undervalued if you're actually underperforming. So that would be the point. Like if your multiple is trading less than everybody else's, you're not a bargain. You're trading for a multiple that is below everybody else's because people don't expect you to have the same growth return combination. Because what I really want you to understand by looking at this table here is multiples are just an expression of growth and ROIC. That's all they are, right? Multiples are an expression of 3 things: growth, ROIC, WACC, growth, spread. That's it. Multiple is just a growth spread combination. If your growth spread combination is worse than the average, you're not undervalued. You're valued appropriately. You're just trading at a discount to the average because you don't have the growth spread of the average. You want to be average, get the growth spread of the average. Then I'll start paying for what you're worth. Because if your spread growth is less than the average, the math says in a DCF that you won't have as much cash flow in the future. You can't be worth the same as your peers. That's the answer to the question. Does that make sense to everybody? Questions about that?
Professor, couldn't there be a company that's trading at a much higher multiple, but they actually have a low ROIC and they're just trading at a high multiple because the market's kind of bid them up?
But think about that. If I'm trying to justify that in a spreadsheet with a DCF, how do I justify that?
Well, I would assume smart money would not justify that, but the market
Listen,
might. still be-
Forget smart or not. I ask you to do an as is on that company. Okay. What are you going to have to put into your as is?
I guess we'd change the growth rate to match.
You'd have to have a higher expected growth or a higher expected ROIC to justify that higher price. So the same would be true with a multiple, meaning if a company has a high multiple, it has to have a higher expected growth and a higher expected ROIC. Now we can argue separately about whether we agree with that, but the math would say that that would have to be true. You see my point?
Yeah, that makes sense.
So that's the idea, is that I can say, all right, I don't think that this company is valued because I don't think that people understand the long-term value of the company. Think back to Apple. I don't think that the analysts are really understanding that Apple's going to do really well in the long term. They're being myopic about the last 2 quarters. And so therefore, Apple's growth rate is probably going to be much higher than what they're currently forecasting. And therefore, I'm willing to pay more for Apple than they are. And that's how I can justify a higher multiple. But in order to still get to that point of logic, I have to come up with something that says higher growth, a higher ROIC. Because if I don't get higher growth, higher ROIC, I don't get more cash flow. I don't get more value. Which gets back to multiples are just an expression of growth in ROIC. That's what I wanted you to see on this table. I could do the same thing for price to earnings multiple. Okay. The basic difference between the generic multiple that we did and a PE multiple is PE is earnings and cash flows to equity holders. So if you actually want to look at the formula for valuing equity, basically we take the key value driver formula here. And what we do is we just place all equity values into the formula, meaning profit is net income. That's the income to the shareholders. Therefore, the G is the growth in the net income. Same formula, just growth in net income, as opposed to NOPAT, growth in NOPAT. Instead of ROIC, it's the return in the equity. So I'm just doing an equity cash flow. And for the discount factor, I'm discounting at the cost of equity. I'm not discounting at the WACC. So same formula, just net income, growth in equity, return in equity, cost of equity. That would get me an equity value of the firm. Okay. And so how do I turn that into a PE? Here's a concept. I have $100 million in net income. I have a 10% cost of equity. At these return in equities and these growth in net incomes, these are my values. So basically, a company that had $1 billion of value with a 10% ROE, regardless of the growth, would trade billion divided by 100 million, would trade at 10 times a PE ratio. So zero spread is at 10 times PE. Positive spread, higher than a 10 PE, negative spread, lower than a 10 PE, same concept. You know, if I said this company's trading at 8 times earnings, well, I know it's going to probably be somewhere in that range of growths and return on equities. If a company's trading at 12 or 12 times, where's my 12s? Probably somewhere in this range of return on equities and G's. But the whole idea is a 12 times PE is a positive spread, a 8 times PE is a negative spread, and a 10 times PE is a break-even spread. Everybody following all that? So what the book makes an argument for, and I tend to agree with them, is that enterprise value multiples are better than price to earnings multiples when we do multiple analysis. The reason why is that even though the price to earnings multiple is the most common one talked about and the common one used out there in the vernacular, price to earnings is based on earnings per share. It's based on net income. And net income is based on accounting, which means that when we have to explain the multiple, we have to explain everything that goes into the multiple. We have to explain everything that impacts net income. And there's a lot of things that impact net income. Okay. It's not just the margins. It's also the non-operating gains and losses. It's tax rate. It's interest expense. Right. There are more things that go into explaining a net income than an EBIT or an EBITDA. Because when you stop at EBIT or EBITDA, everything below it, you don't have to worry nearly as much about. So EBIT multiples and EBITDA multiples are less sensitive to debt, therefore interest expense, therefore capital structure. So PE multiples can be changed and distorted when the debt is different across companies. Enterprise value multiples, not so much. Because the whole point is enterprise value is operating and non-operating value. It's before the debt value. So they tend to be less susceptible to debt to equity distortions. They also tend to be less susceptible to those non-operating gains or losses, which are usually below EBIT, the one-time items. So I'm not saying that they wouldn't affect the value of the company, but they tend to give you cleaner multiples. So generally, pros prefer enterprise value multiples over PE multiples, right? But nonetheless, they'll still use PE. So what is an enterprise value to EBIT multiple? Well, here's the point. All multiples are just key value driver equation rearranged because it's free cash flow rearranged. Start with the key value driver equation. What is NOPAT? It's EBIT after tax, EBIT times 1 minus the tax rate. Divide both sides by EBIT, enterprise value to EBIT. This cancels out is 1 minus the tax rate times 1 minus the growth of our ROIC over WACC minus G. This is the formula for an enterprise value to EBIT multiple. So this is the formula for a PE multiple. If I switch in equity values, rearrange it, this is EV to EBIT. And so the whole point is all these multiples are just the key value driver equation rearranged. Questions about that? I know I'm going through this relatively quickly. What is the enterprise value to revenue multiple? This is our key value driver equation. So here's how we get to enterprise value to revenue. So start with our key value drivers. What is NOPAT or NOPAT? Well, it's our revenue times our margin. Okay. So this is the NOPAT formula, EBIT times 1 minus tax over revenue. That's our NOPAT margin times revenue. Okay. And then if we divide both sides by revenue, we are left with margin times 1 minus the tax rate over 1 minus the growth of our ROIC of WACC minus G. This is EV to revenue, also EV to sales. So PE, EV to EBIT, EV to revenue. Those are the 3 multiples. All of them derived by key value drivers. This is what I told you a week ago. We were building our valuation models that we were kind of cheating on because we hadn't gotten here yet. Here's what's interesting. Enterprise value to revenue is this formula. What is this formula? It's your margin times the rest of this. The rest of this, 1 minus the tax rate, 1 minus G over ROIC, WACC minus G, is the enterprise value to EBIT formula. It's that formula. So enterprise value to revenue is margin over enterprise value to EBIT. Therefore, this divided by value over EBIT equals margin. This is your EBIT. Hard drawing with my mouse. This is the EBIT margin. If you remember, in our valuation model, let me just pull up one of those. For example, when we did Starbucks, here in the assumptions, I told you if we took our enterprise value to revenue divided by enterprise value to EBIT, we would get our EBIT margin. And we use that here to estimate that number in perpetuity. There's our perpetuity EBIT margin. M9 in our perpetuity margin, M11 in our, which is EBIT margin in a perpetuity. Make sure I got the right one, M9, yeah. We use that to estimate that number, right? Trading multiples estimated that number. Well, that's all based on this formula. Okay, because two things have to be true. If this is based on the key value drivers are based on free cash flows. If we rearrange the key value drivers, we get the multiples. So therefore, if we start with the multiples, we should be able to triangulate back to the free cash flows. So multiples working backwards help you understand free cash flows. So to summarize everything we've said at a high level, cash flow leads to price. That's DCF. Multiples start with the price, and you can work backwards to infer what the cash flows have to be. DCF says if you know what the cash flows are, you know what the prices are. The two always have to be equal. That's what I mean by triangulation. Questions, comments? All right, so here's what we're going to do. In just a minute, we're going to take a break. When we get back from the break, I want you to download during the break these two files, and we're going to talk about how we do multiple analysis. So in the files folder under week 5, I put these files here. Make sure you grab these files. And we'll be talking about those in 10 minutes. So 8:21, we will come back from our break and talk about multiple analysis. All right, starting the recording again. Break time over. Before we jump to the files and our next step on analyzing the multiples, questions about anything we went over? Okay, so there are 3 files that I hope you downloaded. Just click on these. So the first one has data for 3 pharmaceutical companies, Merck, AbbVie, Lilly. The second one has data for Costco, Walmart, Target, 3 retail companies. And the third one is a blank template with Costco, Walmart, Target that we can do for any of the companies, any 3 companies. So let's talk about Costco, Walmart, and Target. File. Share. All right, so this template has two tabs. The first tab is the price to earnings multiple. And the second tab is the EV to EBIT and the EV to sales multiple for each one of the companies. Right. And in this example, we have the three retailers, Costco, Walmart, and Target. Okay. And so the idea is this is the key value driver formula. Okay. And these are the four parts of the key value driver formula: profit, G, ROE, in this case, replacing ROIC, and cost of equity replacing WACC. But these are the four elements. If you put these four things in, we get the value. We've already done that earlier in the semester. Okay. Value divided by net income equals PE. Okay. So basically, if you put in the key value driver, it will create a PE based on that value. This final yellow cell was at the time of this analysis, the actual PE in the real world for each of these three companies. So the idea was we want to match the PEs of the key value driver formula to the PEs of the actual companies, kind of like an as is for multiples, right? So translation, if this is the multiple, these are the likely numbers of the key value driver formula that lead to the multiple that the company was trading at the time, right? Language. If Costco's PE is 31 and Walmart's PE is 22, then Walmart would be considered to trade at a discount to Costco, right? If Target's PE is 15 and Walmart's PE is 22, Walmart is trading at a premium to Target. Okay, it's just language that people use. All right. But what I want you to do is, looking at this data, tell me why Costco's multiple 31.45 is higher than Walmart's 21.84. Why is Costco trading at a premium to Walmart? Add a 2-2.
I would say because of the high growth rate compared to Walmart.
So the 7% versus the 4.25%. So higher G.
Correct.
That's one of the reasons why they're trading at a higher multiple.
Higher spread.
Higher spread. 25 minus 9.3 is higher than 21 minus 7.9. So they got a higher spread of about 16 points versus about 13 points. And it's the growth spread combination. Higher growth and higher spread lead to higher multiples. Multiples are just growth and spread. That's what you see, and it's playing out here to the 31.45. But there's a third factor at work here. With that high G and that high spread, that multiple could actually be higher if they had the same cost of capital. Walmart actually has a lower cost of capital than Costco. 7.9 versus 9.3. If Costco had the same cost of capital as Walmart, what I'm going to do is I'm just going to take, this is 1.4, 140 basis points higher. So equals that minus 0.14, 0.014 equals that minus 0.014. So I'm going to keep the same spread, but I'm gonna make the cost of capitals the same. Notice what happens to the Costco multiple. It would be 79. So even though they have a higher spread and a higher growth, their PE would be 79 if it was the same hurdle rate. But because Costco undo has a higher hurdle rate, 9.3, their PE is only 31. So if you look at what's going on with Costco versus Walmart, Costco has higher growth, 3% higher G. Costco has higher spread, 13 points of spread versus, 13 points of spread at Walmart, and we'll call it 16 points of spread at Costco. So higher growth, higher spread, but that's offset by the fact that Costco also has a higher cost of capital. Their PE would be even higher. So if we're trying to explain why Costco is trading at a premium to Walmart, those are the three things that we would have to address. Differences in gross spread and differences in hurdle rates. Does that make sense? Why is Target trading at a discount to Walmart? Why is Target's PE 15 and Walmart's PE 21.84? Adam?
I would say their growth rate is lower, and they have a higher hurdle rate of 10.10%. One thing that helps them is that their spread is significantly larger.
But if the spread is larger at Target, wouldn't that mean Walmart should have a lower PE?
Well, it's all relative, right? The growth rate on Target and the cost of equity for Target is more detrimental than their spread.
So let's just say I make this 21 and I make this 7.9. How much of a difference in calculated PEs is that higher growth rate?
Not a lot.
So what I could say is for similar growth at a higher spread, shouldn't this be higher? For similar growth at a higher spread, would the PE be higher? Well, if I made that 7.9, should be 24, right? So why is Target trading at a discount to Walmart? Why are they trading at 15?
Higher spread.
Why is Target trading at a lower PE than Walmart? It's not the spread.
Higher cost of equity.
It's all the cost of equity. So it's the fact that I'm discounting those cash flows at 10%, and I'm discounting Walmart's cash flows at 7.9%. That higher discount rate is why Target's PE is lower. Because otherwise, at a similar growth, at a higher spread, Target would actually have a higher PE. It would have to. But they don't. So this is the part that's often overlooked by most people when they do a multiple analysis, because most people that do a multiple analysis ignore that. They ignore the hurdle rate. They assume everybody's hurdle rate's the same. And so therefore, it's the growth and the return that explains the multiple. And what I'm telling you is growth spread explains multiples. Those are two drivers. But the third driver is the actual discount rate. Because if a company is discounting at a higher rate, they are worth less. That's pure NPV. Well, that's what's playing out here. Target is actually trading at a discount because those higher cash flows are being discounted at a much higher rate, which is why their PE is lower than Walmart. So Walmart benefits by being perceived to be less risky. Questions about that? Does everyone make sense on that? Now, spreadsheet number 2, or tab number 2. Enterprise value to EBIT multiple. Okay, if we remember, do this. So, too slow. I'll take a screenshot from the PowerPoint. This is the rearranged key value driver formula to get enterprise value to EBIT, right there. So what goes in enterprise value to EBIT? Growth. Now this is growth in the cash flow. Tax rate, the T. Expected ROIC, and the WACC. So these 4 things lead to this. Okay, so same concept. These 4 things give the exact same EV to EBIT in our model as the trading EV to EBIT of Costco the day the spreadsheet was put together. So basically, Costco's trading at 23 times EV to EBIT, and because they have these 4 things. So same concept. Why is Costco trading at a higher EV to EBIT than Walmart? What would explain it? Why is Costco trading at a premium to Walmart for EV to EBIT, given those 4 factors? Isabel?
Costco's operating ROIC is much higher than Walmart's, and therefore also the spread is higher between that and the WACC.
Okay. What about the tax rate? Does that matter?
No, because it's the same for both.
Okay. And how does the WACC itself impact this?
The WACC G, like the difference between those, well, let me think about this. The smaller that difference is, the larger impact it will have. Is that right?
So somebody wrote in the chat, the WACC could impact it negatively, meaning a higher WACC hurts your EV to EBIT multiple. So a lower WACC helps your EV to EBIT multiple, meaning watch what happens if we change this to 7.2. EV to EBIT would jump to 115. So for that growth and that spread, they'd have a really high multiple, right? But they don't, because I'm discounting those cash flows at a higher rate. So one thing that is hurting Costco, or you could say helping Walmart with this multiple, is Walmart, despite the lower growth, lower spread, has a lower hurdle rate, which actually helps their EV to EBIT. Costco has a higher growth, higher spread, but that is dampened by the higher cost of capital. So headwind, tailwind, tailwind, neutral. What about Target? Target versus Walmart. Why is Target trading at a discount to Walmart? EV to EBIT. Adam?
So the main two contributing factors is that they have a lower operational ROIC and a higher weighted average cost of capital. The other rows 5 and 6 benefit Target, but not to the same token as rows 7 and 8 hurt them.
Yep. So even though Target has that much higher G, 8%, they have a lower spread, as you just pointed out. They're benefiting slightly by a lower tax rate, but that much higher WACC is also hurting them. And that's why they're trading at a discount. Interestingly, Target's PE also traded at a discount, but we have a little bit more granularity here in the EV to EBIT multiple. Is everybody following that? Can everybody understand the differences there? Multiple number 3, EV to sales. Two things. The bias for EV to sales is that EV to sales, if we go back to the formula, over here, EV to revenue, EV to sales, same thing, is heavily influenced by margin. If you have a higher margin, you generally trade at higher EV to sales. That's the bias. So the idea is, if I make a 10% margin and you make a 5% margin, when I sell $1 of sales at 10% margin, I make 10 cents. When you sell $1 of sales at a 5% margin, you made 5 cents. Play that out over time. I keep making 10 cents every time I sell something. You keep making 5 cents every time you sell something. Every time you sell something, I'm going to be worth more. Okay. So that's the idea, EV to sales. Okay. So EV to sales is heavily influenced by margin. However, it's not just the margin. Okay. Because EV to sales is margin times enterprise value to EBIT. And built into enterprise value to EBIT are the other factors, meaning, yes, margin's important, but so is the ROIC and the tax rate, right? And the growth rate. So it's margin and those three, but margin kind of trumps the most important factor. It's the way we start with EV to revenue analysis is we start with margins, but recognizing these other factors may drive it as well. So therefore, let's go here, right? We know that ROIC is margin times productivity. That's from our trees, okay? Which is the invested capital to sales multiple. So here's the idea. If I know my ROIC and I know my margin, because my margin is my EV to sales divided by EV to EBIT multiple. If I know my margin and I know my ROIC, I can infer a productivity. But this times the productivity equals that, right? So if I know this and that, I can solve for this. That's actually what the spreadsheet does. So built in the multiples is an understanding of your margin into perpetuity, which is we've already used in our valuation model. Built into the multiples is an understanding of your productivity into perpetuity. Okay, well, let's go back to the EV to sales multiple. Why do I pay more for $1 of Costco's growth in sales versus $1 of Walmart's growth in sales? Meaning if Walmart grows $1, it adds 70 cents in value. If Costco grows $1, it adds 83 cents in value. why is Costco trading at a premium for its sales? Let's start with margin. Is it because Costco sells their products at a higher price, higher margin? No. So I told you margin should be a driver of this, and Costco has a lower operating margin than Walmart. So why are people paying more for Costco's sales?
It's more productive.
I'm sorry,
It's more productive. Costco is more productive.
you're exactly right. So put that into numbers.
Costco has, I don't know how to describe it, but like it's the lower, the better in the numbers. So, its productivity of 0.1 is, it can do more with its capital than Walmart can at 0.32.
Yeah. So what does what does 0.1 mean in the terms of our ROIC tree? To generate $1 of sales, how much does Costco spend on invested capital?
10 cents,
To generate $1 of sales, how much does Walmart spend on invested capital?
32 cents.
That's the key.
Okay.
Walmart is spending 3 times as much as Costco to generate those sales. So even though Walmart makes more in every sale, because they spend 3 times as much to make the sales and therefore would have to reinvest a whole lot more to make those sales. That's why Walmart has less EV to sales. These sales are not as attractive, even though they're higher margin, because they have to reinvest so much. That's why they're trading at a discount. Does that help you articulate that, Caitlin?
Yes, thank you.
But you had the right idea. You had the absolute right idea, because that's the point. Because if you just looked at the data, you're like, oh, I'd pay more for Walmart sales. They should be higher, but I didn't. So the second thing that was work here is the productivity. Right now, this is a 3 times productivity bet. So that should be really helping Costco, right? There's a third factor at work, though, that hurts Costco. The third factor that works in all of these is the WACC itself, because I'm still discounting the cash flows from these sales and the cash flows from the productivity at a higher rate. So same concept. If Costco had the same WACC as Walmart, I'd pay more for their sales. So headwind to Costco's EV to sales is their cost of capital. But generally, why is the EV to sales higher at Costco despite the lower operating margin? It's all about the better productivity. Why is Target EV to sales higher than Walmart's?
Higher margins.
Yeah, that's one of the reasons. They're just out and out making more money, and therefore I pay more for more money. Why is it an even higher EV to sales? Why isn't it as high as Costco's? Why is Target below Costco? EV to sales.
Productivity.
Yeah, because they're spending 5 times as much to get that margin as Costco. And so even though Costco has the lowest margin of all 3, it has a higher EV to sales because of that productivity. We're going to talk in just a couple minutes about how to put the data in to create these numbers, but I just want to make sure you understand the relationship between the numbers. Does this make sense so far? Okay, so here's what I want you to do then. The spreadsheet, second one is on, what 3 companies did I give you in the other file? Merck, was it Merck, Lilly, and somebody? Second file has Merck, AbbVie, and Lilly. Okay, so here's what I'm going to do. I'm going to put you in the breakout rooms for 10 minutes randomly again. And in your teams, I want you to discuss all 3 of those multiples and explain Merck against AbbVie and Lilly. Why is Merck trading at a premium or discount in the PE to both? And why is Merck trading at a premium or discount in the EV to EBIT for both? And why is Merck trading at a higher or lower EV to sales, EV to revenue against AbbVie and Lilly? Okay, 10 minutes, work through that, come back, have a spokesperson so I can call on you and you can explain. That's the data that I want you to look at. Talk about. We'll do. All right, welcome back. So does one of the teams want to kick us off and help us understand what's going on with the PE multiples for the three companies?
Can do that.
All right. You want to go ahead and share and walk us through?
Yeah, let me find the right Excel spreadsheet here.
See, now you know my fun part when I have like 10 different files open.
Yeah. At least these ones are not heavy like your other model ones. They were crashing my computer when I had like 4 of them open.
Okay. Yeah, they're smaller files. Great, can see it.
You can see it. Okay, I'm sharing the right thing.
Mhm.
Okay. So we're comparing why Merck is trading at a discount from a PE ratio perspective to AbbVie. They have a lower spread comparatively to AbbVie, which hurts them. They have a higher or a lower cost of equity, which helps them. But also they have a negative, growth. They're contracting, which obviously doesn't help. So that's fairly easy to see why Merck is trading at a discount compared to AbbVie. If we jump over and compare Lilly to AbbVie, Lilly is trading at a premium to AbbVie from a PE ratio perspective. They obviously have positive growth, which much more so than AbbVie, which helps. They have relatively similar spreads, I guess, although AbbVie's is a little bit higher, but their cost of equities are pretty similar as well. So Lilly's growth is obviously a lot higher than AbbVie.
Okay. And what about the cost of capital again?
So the cost of capital between Lilly and AbbVie is relatively close. Lilly's is higher, so that hurts them. If they had an equivalent cost of capital to AbbVie, their PE ratio would be even higher.
Yeah.
And
And
since
then
it's a little bit higher, that actually hurts them a little bit.
what about for Merck again?
Same thing with Merck, since it's a lower compared to AbbVie, that's actually helping them. If they had an equivalent cost of capital to AbbVie, their PE would be even lower compared to AbbVie.
Right. So is it pretty clear to your team what you just said in terms of why Merck is trading at a discount to both?
Yeah, it made sense. It helped here too. We kind of noticed that all their trends kind of trended in the same directions. That helped kind of see it pretty clearly.
So it's a little bit more straightforward. Okay.
Yeah.
All right. Good job. All right. Well, thank you for kicking us off. Any questions for any of the other teams? You have some more insights? All right. So you can stop sharing. Let's get another team to do EV to EBIT. Different team of the remaining
We
three.
can jump in.
All right.
Can everyone see that? Yes. Okay, great. So similar story to the negative growth. Merck is obviously significantly less productive. They're spending an insane amount per dollar of sales. And it's similar ratio. AbbVie's middle of the road. These are still incredibly high numbers, but I'm guessing this is just normal for pharmaceutical companies that have to spend so much on R&D. The effective tax rate is also same scale. Merck is worst, AbbVie middle, Lilly's best. Cost of capital reverses, or WACC reverses. Merck has the best, but that's still not quite enough to offset the fact that they have negative growth, highest effective tax rate, and worse productivity. Yeah, again, I think the overwhelming factor for all of these is just the fact that the growth rate is pretty different across the companies. It's hard to overcome negative growth. That's never a good sign.
All right, but back to EV to EBIT, just be more specific about Merck and AbbVie. Why 12.1 at Merck and 13.99 at AbbVie? Why is Merck at a discount to AbbVie again?
Well, Merck's at a discount again because they're less productive and they're contracting.
So the negative 1%
Their
G.
margins lower.
And then what about the spread?
They have a narrower spread, significantly narrower spread.
Yeah, so they're contracting a narrower spread, which, you know, the math should work out to a lower key value driver formula. So what about the tax rate?
They have the highest effective tax rate. I'm not sure that that's the biggest driver here, but that definitely is hurting them.
Yeah. Well, what I want all the teams to do is just make sure you talk about all the drivers. Even if it's a neutral driver, I still want you to talk about it. So tax rate should slightly be hurting Merck's EV to EBIT relative to AbbVie. The spread is lower. The growth, obviously negative versus positive, is lower. The only thing that's really helping Merck is the fact that they have a lower WACC. So that's the one benefit at the time of the multiple is the WACC, but otherwise the other three kind of winds are blowing against them when it comes to a lower multiple, according to the math. So I just want to make sure you cover all the drivers when you go through that. Now, what about Lilly and Merck? Why is Lilly trading so much at a premium to Merck?
Well, Lilly has almost everything going for them except for ROIC and WACC. They're growing. They have a lower effective tax rate. They don't have as wide a spread, but it is still relatively high. The only strong negative is that they have a higher WACC.
Yeah. But that growth does make a difference, as you can see there in that multiple. I mean, it really, I mean, if you can grow 5% a year forever, and my competitor's shrinking at 1% a year forever, it's going to make a big difference over time, especially when you have positive spreads. So for Lilly, the biggest driver of that is the growth at a high spread. But other things, you know, the wins, as we talked about, will go in the directions they did.
Just
All
out
right.
of curiosity, what is this like from kind of data now, or what time frame is this from?
This is like April 2023,
Okay.
so probably about 4 or 5 months ago. We could do a refresh as of today, in just a second. But does everybody kind of understand what he just went through? Got similar thoughts on your teams as you went through this? All right, good job. So final team, EV to sales. There's 2 teams left. The EV to sales, EV to revenue multiple.
My team can go, I'll share my screen.
All right, great.
Okay, can you see this?
Yes.
So starting with Merck to AbbVie, the EV to sales for Merck is at a discount to AbbVie. And that was, we said, was driven by between operating margin and productivity. It's not so much driven by operating margin, which or sorry, compared to AbbVie, it is driven by operating margin. But mostly because Merck is less productive. It takes $1 for Merck to spend for the same thing that AbbVie, it takes 83 cents to do. So they're less productive, and that's borne out in the EV to sales.
Okay, so they're making less margin, worse productivity, pretty clear why the EV to sales is lower.
Yeah.
Okay, what about Lilly? Why
So
is EV to sales so much higher than Merck's?
for Lilly, the operating margin is lower, so it's dampened by the operating margin, but it's offset so much because Lilly is so much significantly more productive. Their to Merck's $1, they're spending 68 cents to do the same thing. And so they're significantly more productive, and that's driving the higher EV to sales.
Yeah. So what's really important about this, so good insight there, is that I go back to the bias. Like there's this bias that EV to sales is just margin. And like I said, it's heavily influenced by margin. And most of the time it works out. You have a higher margin, you have an EV to sales. I pay more for sales because I make more money. But here's an example where Lilly, you pay more for their sales, even though they have the lowest operating margin, because they don't spend as much money to get it, as you just said. And a lot of people just overlook that second fact, or overlook the discount factor that plays into this as well. So this is just a more nuanced, advanced approach, but good job, team, and explaining the EV to sales. All right, questions about what you just did? Because that's going to be your next week's homework assignment, to do that. All right, so let's go do another one of these. So in order to do so, you need that third file, which is blank. Okay, so let's go ahead and create this, and I'm going to show you how we create it. We're going to create it together. So we're going to start with the blank assignment. So file. So let's do Meta, it's Facebook. So Zoom, share, desktop. This will be easy to see. All right, so in this file, what we're going to do is across the top, starting with the PE, first company we'll do is Meta. META, and we're going to compare them against Amazon and Google, because these are three advertising companies. Now, I say that with a slight bit of a chuckle. What's the problem with that?
They
These
all
are
do
we're
more
three
than-
companies: Meta, Amazon, Google.
They all do so much more than advertising.
Well, yeah, the biggest one being Amazon. So this is what I mean by your pure analysis gets to be a little bit problematic when you try and look for people to do some more things, because people can lump Amazon against Meta because Amazon has a pretty big ad business, but it's actually not what most of what Amazon does. But like, who do I look at as Meta's competitors? Because for ads, Amazon does do ads. So this is where it gets a little bit more problematic, but nonetheless, we're going to compare these three companies. Right. So we'll start out with their PEs. So what do we need? And again, I'm going to tie it back to Bloomberg. So we're going to start with Meta. META. Spelled today. All right. So in no particular order, I'm going to start out with the WAC. Right. And I'm going to take a screenshot here. So you have your roadmap. So this will be the Meta WAC. All right. So on the screen, there's two pieces of information you need. Cost of equity is right here. Right. So this is the cost of the equity, cost of the debt. This is the WAC. So we do PE, we do cost of equity. So 11.2% today. So basically we come in here 11.2%. Okay. Then since I have it in my second tab, I need a WAC for Meta, and back to screenshot, their WAC today is 10.9. So 10.9 for the WAC. So that's the WAC. That's the cost of equity. Go ahead and put it both in. Right? Now, our next screenshot is going to come from, it's called the EEO, which is the earnings forecast screen. Screenshot, save. EEO, earnings estimates. This is the consensus earnings estimates. All right, so I told you before that we care more about forward multiples and forward numbers. So we care about, this is actual, these are forward year nomenclature, forward year 1, forward year 2, forward year 3, forward year 4. Okay. For our purposes, we're going to care more about forward year 2 and forward, because this is the first clean 12-month forecast year. It's forward year 2. This forward year 1, which is December 23, includes actual and forecast data. So these are more normalized. So we're going to use forward year 2 for our purposes in this class. Right? Forward year 2, 2024 net income forecast for Meta, 43,729,000,000. 43,729. Now, I'm going to take a second screenshot, but before I do, down here is the price to earnings ratio in 2024 today. So the way it's calculated is we take the current share price, 305, divided by the 2024 earnings, and we get the 2024 PE. Okay, so 18.21. That's the actual PE for Meta today. Now over here in the EV to EBIT, I need an EV to sales and an EV to EBIT. So same concept. In 2024, EV to revenue, EV to sales is 5.17. And EV to EBIT today, they traded at 14.3 times 14.38 times 2024 earnings. And by the way, if we were to take 5.17 divided by 14.38, that would suggest a 36% EBIT margin. That's the operating margin. The model's already calculating that for us. Everybody follow me so far? Okay, so back to PE. The last thing I need is I need to do the PE, I need an expected return on equity. Okay, now down here, if I scroll down or minimize, the analysts are actually forecast return on equity for the next 4 years. And what I need is something representative of perpetuity. So here's what I know. Last year, the return on equity is about 18.5%. This year, 24.5%, then 25%, then 23%, then 16%. So what do I think is the ... perpetuity number? Okay. If I didn't do a valuation, I had to come up with, if I did my valuation, I can go back to my valuation model and kind of figure out what I used in perpetuity. But here, what would we want to use as the long term? Okay. Do I think the dip means 16 is what their long term really is? Or do I think it's probably somewhere in the middle? All right. I'm going to give them credit for a little bit higher. I'm going to say 22%. Okay. But the point is, we have to come up with a long term. And my assumption is that, yes, it does dip in 2026, but stronger for 3 years. And if they do have improved performance, then maybe it'll be a little bit closer to this number than that number. So I'm arguing 22, but this is going to be important to our analysis, is where do we end up with a perpetuity of ROE? But using these numbers, I'm going to come up with 22. Okay. Now, here's the point. What is my growth? If I know my spread, growth and spread equal PE. So with no growth, the key value driver formula right there gives me a PE of 8.93. Sorry, key value driver formula right there. And then value divided by income gives me that PE. With no growth and that spread, they traded a PE of 9. Today, they're trading at a PE of 18. which means they have to be growing. So same concept we did in their valuation model, we can use goal seek. So goal seek, what I want to do is I want to set cell here, B9, to what I want, 18.21. I want my model to match the observed PE in the real world. And I wanted to do it by solving for a G, solve for B3. So basically 7.61%. So with that G and that spread, you get that PE. So basically we get the data for the forecast for the net income. We get the data, the estimated return on equity long-term. We get a data for today's cost of equity. We solve for a G. Questions about how I got to that G or what we just did? All right, EV to EBIT. Next, we're going to solve for a G here as well. Okay, because the assumption is, and this is a very important assumption, ROIC is more stable than G and easier to forecast for us. So therefore, if multiples are growth and spread, and I can probably forecast the ROIC more straightforward, I solve for the G. If I can't figure out the ROIC in perpetuity, I forecast a G and solve for ROIC, right? But generally the approach is forecast the spread, solve for the G, except when we have exceptions. So I need to forecast an ROIC in perpetuity for Meta, and I need a tax rate for Meta. So let's start out with a tax rate. Option one, is there any guidance for the tax rate? Right now, Meta is giving tax rate guidance of 20% on a go-forward basis. File, screenshot, save, Meta, GUID. 20%. I need an ROIC for Meta. Go back to this screen. This is the Bloomberg ROIC, not the operating ROIC. So we're going to have to make two assumptions here. Assumption number one, that this and the operating ROIC are not too different. Okay. Now, if they are, we should use the operating ROIC, but here we're going to proxy out the current ROIC as close to the operating ROIC. That's point number one. Point number two. Now, I actually can estimate what the operating ROIC is. So add that. So if I don't have the operating ROIC, I use the actual ROIC and say it's close. Because Meta has a lot of cash like Apple, their operating ROIC is higher than their average ROIC, which is 14.6. Their average operating ROIC is 21.55. So I probably want to use the 21.55, not the 14.56. Okay, so that's the first part. So let me save this as a template. All right, question number two. Is this indicative of perpetuity? So first, we need to understand it's the operating ROIC. Second, we need an op ROIC in perpetuity, not an op ROIC for 2022. So that would be the question. So here's the point. If I think Meta's ROE is going to be pretty stable, close to where they are today, then I'm implicitly saying that their operating ROIC is going to be pretty stable to where it is today. Because the only difference between the two is the cap structure, and cap structures don't usually change too much over time. So therefore, if the ROE is stable, the op ROIC is stable. If today's op ROIC is close to that ROE, then what I'm telling you is I'm going to use today to be tomorrow. Okay, that's one way to do this. Now, here's the thing, because I lowered the cost of it, lowered the ROE to 22, not 24, then I probably need to lower this to, let's say, 20. Because the ROIC by definition has to be equal to or less than the ROE. Because that's the whole point. It's the debt to equity cap structure that leads to this. So given I lost 2 points of ROE, I'm losing 2 points of ROIC, and I'm just doing this as a proxy. But I'm assuming similar cap structure. I could do a different way. I could look at the debt to equity ratio, which is on the wax screen. And right now, they're 95% equity, 5% debt. So whatever cost of capital they have is going to be pretty close to their cost of equity because they're 95% equity. So 21. Use 21. Assuming I'm using a 22% ROE. So here's the point. Use goal seek. I want to set with no growth, I'd have a 7.34 EBIT. So I want to set that to solve for a 14.38 EBIT by changing my G's. So the G is 7%, given these three numbers. But obviously, if these three numbers were slightly different, for example, if I had a 20% ROIC, I'd have a slightly higher G. If I had a 21.5%, I'd have a slightly lower G. But the point is, I kind of estimate my spread, estimate my tax rate, solve for my G, so that these two become the same. That would be the process for Amazon and Google. Questions? All right. So those were the files that we just did. Let's look at Google. All right, Google today. $10.7 WACC, 10.8 cost of equity. So 10.8 and like 10.7. They have very little debt. .7. It's Google. That should actually be 10.8 here. All right, so that's the WACC. Then for Google today, PE, second forward year, 19.72. EV to EBIT 5.52. EV to sales 5.52. EV to EBIT in 2024 is 15.81. So we can already see that Google is trading a little bit of a premium to Meta today, based on their forward PEs. Next, second forward year earnings, Net income, 87,431,000,000 of net income. Very profitable company, 87,431.
Is that 1772 and D10 supposed to be 1972?
Yes. Thank you.
Yep.
Okay. And then finally, and that, I think I took a screenshot of this. Just want to upload all this for you. This is Google. What was that? The EEO. And then what I'm going to do is I'm going to just minimize so I can see the return on equity forecast. And when you see a file called EEO2 or EEO3, that's the difference. It's just the same screen, just since I can't scroll down, then I'm going to add a 2 to it. Just so you can see the bottom half of the screen. So return on equity, last year, 23.6, 25, 25, 23, 25. I'm going to use 25 long-term, say that they're going to stay at about a 25% return on equity into perpetuity, which means if I use my solver, goal seek, I'm going to set that to be the 1972 corrected by changing my growth rate. And that gets me a growth rate of about 7% as well for Google to get to the $1.7 trillion market cap. Right. So got my Google. I need to get my EV to EBIT. So I need a tax rate and I need an ROIC. So back to Google. If I look at the guidance, did they give any guidance on their tax rate? Unfortunately, no. Option 2. Is there an analyst report that I could use to try and grab it? Here's a recent JP Morgan report. And hopefully this one has a forecasted tax rate, which they do. Going in their model in the out years, use last year, 15.9 as the out year tax rate. So 15.9. It's about 16%, about what you guys are using for Apple. And then I need an ROIC, right? As I said, if I tie ROIC to ROE, because they have no cap, no debt in their cap structure, it's going to be pretty close to 25%. So their ROIC is going to have to be about 24%. Just math, given that they have no debt. Or what I could do is I can come in here, same concept. What's this document viewer? There we go. Go to their peers and look at their operating ROIC. And right now, their operating ROIC for last year in 2022 is 43%. Okay, so I have to make a choice. If I were to use 43%, I can't use 25 because the ROE would have to be higher than the ROIC, just mathematically. So they have to be somewhat in sync with each other. So I have to make a choice. If their operating ROIC, what last year was 43% in perpetuity. Suggests their ROE, then this is gonna have to be some number like 46%. If I really believe in perpetuity that it's gonna be what the analysts are thinking, then last year's operating ROIC is gonna have to fall. And it's gonna have to fall to a more reasonable level. And again, considering that they have very little debt in their business, 25% ROE suggests about a 24% ROIC. And I'm just gonna have to make a choice. Like, which one do I think is more reasonable? Right? For our purposes, I'm gonna tend to go with the analyst ROE. So therefore, this is gonna be my perpetuity ROIC, but somewhere around 24%. And then I'm gonna solve for my G. So tools, goal seek. Same process. Set the EV to EBIT to, in this case, 15.81. By changing the G, and that would give Google about a 7% G from a cash flow perspective. Again, making a couple assumptions along the way. Everybody with me so far? Good. So I'm going to save what we have done. And then we need the data for Amazon. So data for Amazon, since I'm on this screen. Is Amazon on this list? No, they're not. So let's just get some data for Amazon going here. So this is Amazon's ROIC, WACC, and operating ROIC. Remember, this is historical data. So this is 2022 at this point. So 5% ROIC, 11%, sorry, WACC, and they don't have an operating ROIC. Well, that's a problem. So I don't have a good answer here for what their operating ROIC should be, but this is history. So I'll at least take a screenshot. Amazon, call it the RV screenshot. This is the WACC for Amazon today, which has both their WACC and cost of equity. This is the earnings estimates, which has their forward net income, PEs, and EV to revenue, and EV to EBIT. And their forecasted return on equities. And finally, let's see, back to guidance again. Does Amazon give tax rate guidance? Of course they don't. Is there a JP Morgan analyst report that does? JP Morgan as of today. In the JP Morgan report. Aha, they're giving some forecast tax rates. So here's what I'm going to do. I'm going to take a download of this JP Morgan analyst report and save it. Okay, so in the JP Morgan report is the tax rate. Got the other data in the other screenshots.
So I think I noticed something. Can you go back to the WACC screenshot just briefly? I thought I saw that the WACC was higher than the ROE. Maybe it was just a trick of my eyes, but
The WACC can be higher than the ROE. So they have a negative spread. And that's going to be a problem in coming up with the multiple that's pretty high for Amazon. It can't be in perpetuity. Remember, this is a 1-year view. So somebody earlier in the class said, can the multiple in the future be much higher than it is today? Here's an example. With a negative spread, you can't have a 5% ROE and a 12% cost of equity and come up with a PE that's 43. It just won't make any sense. So Amazon clearly has to have a higher ROE in the future than what they had in the past.
Thank you.
So here's what I want to do. And you're wondering, why hasn't he put any of the data into the spreadsheet yet? Because he is going to go back to the website, and in week 4, he's going to take all the data for JP Morgan and Amazon screenshots, as well as the Google and the Meta screenshots, and upload them to the week 4 folder. And so I'm going to put you back into your teams. And as teams, I want you to come up with an Amazon, put the data in, come up with an Amazon data that explains their multiples. So 10 minutes, figure this one out in your teams. What are these numbers for Amazon? All the raw data is in that folder. Welcome back. All right, so what did we get for Amazon? Somebody want to share? And we show me your numbers, see how they look.
I
How
can
about a
share.
team we haven't heard from?
Never mind.
Did we hear from, who did we not hear from last time? I think maybe we didn't hear from room 3. Caitlin, Chris, Isabon, Peter, Thomas.
Happy to share.
Yeah.
I think Caitlin presented on our
Did we
behalf
do it
last
last
round, but
So maybe we didn't. Who did we not hear from last time? Which team didn't when they went to the 3 out of the 4 teams? All right, in the interest of time, sorry, just go forward, whoever's about to share.
Okay.
We don't have much time.
I can do that. Oh, never mind.
oh, sorry, Julia.
It's okay. Chris, go for it.
Okay. Yeah, so we got to PE of 46.31, a very high growth rate, about 11.2.
How'd you come up with the ROE?
We kind of took, we took the average there of the numbers that we were looking at in that space, and we felt like this was a maybe, I don't know if it was slightly conservative, but it was sort of a middle-ish number there in that range.
But implicitly, what you're saying is that looking at the next 4 years, you think that's indicative of the long term. Because remember, every assumption you put in here is a
Yeah.
perpetuity value. It's not a year 3 value or year 5 value, it's perpetuity value. So 15.5% seemed about right for the long term, which suggested a high G. Go to the next tab.
Yeah.
How'd you come up with the operating ROIC?
A similar logic to what you'd applied for the others, given they're about 89% equity. So we felt like they should be just slightly lower. So we were debating between 15 and 14.5, but felt like a point lower
So
seemed to be.
89, 90% of the ROE is about the 14.5% ROIC, just to keep a consistent cap structure. Is that the
Yeah.
idea? Great. And then where'd you get the tax rate from?
From the JP Morgan analysis, we looked at the out years, felt like 10% was also reasonable. I think they went to 9.9 and then 10.6, but we kind of figured 10 was about fair.
I wouldn't doubt that that would make a reasonable approach given the process we said. But remember, these are perpetuity values. In perpetuity, is Amazon going to keep paying 10%?
Probably not.
So if we do think it's higher, even though I said use the JP Morgan, remember, they're only talking about 3 or 4 years out, and then we're just inferring that that's a perpetuity number. I'm not saying that's, put this way, corporate tax rate is 21. Very few companies actually pay 21, but 10's aggressive. So all I'm saying is maybe a little higher on this one, but let's just say you use 10, and in either case, you're still going to get a pretty high G. So let's just say 10's okay, get a high G. They have lower taxes than Meta and Google. But again, if nothing else, Meta and Google are global companies. Amazon's not yet global. So it's hard to believe a US only company is going to have a lower tax rate given the 21% tax rate long term. But nonetheless, something to think about. But I at least appreciate that you did the right process to get to these numbers and put them in. And I assume other teams did similar to what you see on the screen. Okay, so I was lurking around listening as you guys were putting this together, and I heard a question right before I closed the rooms at the 10-minute period. They said, are we supposed to analyze these? And so the answer is yes. So essentially, your week 6 assignment, individual or in pairs, is to basically take the data that we just created for the multiples of Amazon, Meta, and Google today, and basically explain using this data why Meta is trading at a premium or discount to Amazon and Google using numbers for those 3 multiples: the PEs, the EV to EBITs, and the EV to revenues. So that's your paper, and that's the Excel file that you have to upload for your week 6 assignment. So that assignment is now live and posted, and you have all the data to do that assignment as of right now. Questions about week 6 assignment?
What should we use for the operating ROIC?
That's what you're going to tell me in your week 6 assignment.
Okay.
But what we said in class, and what one of the teams just said here, was, hey, if I want to tie it to the ROE forecast, which you should, there should be a relationship between return on equity and ROIC. And mathematically, it's ROIC times your leverage ratio equals the ROIC, or ROE. ROIC times leverage equals ROE. So that's the point. Like, if I'm 95% equity, my ROIC and my ROE should be pretty close to each other. Should be within 95% of each other. And so that was the assumption that whoever just displayed put up there. That made sense to me. And if you guys do something like that in your explanations, I could buy that. Same thing with the tax rate. Like, you could say, I'm going with the JP Morgan tax rate of 10%, but somebody, Julian, just wrote in the chat, like maybe 15% seems more reasonable. Although when he put in 15%, didn't change the growth rate all that much. Okay. Put that in there, put that in your paper, talk about it. So again, multiples, as I will tell you going into this assignment, I said this at the beginning, they're more about ranges. This is a little bit more of an imperfect science because we're using perpetuities of these just 4 numbers to equal the values of companies and the multiple trading multiples of companies, which means there's a couple of different permutations that will solve for this. So for any company, you can't say this is the exact ROIC and this is the exact G, because slight differences in these change it. But you should have a general idea what the G's are, a general idea what the ROICs are, a general idea what the tax rates are. And that is the basis for the differences that you're explaining in the multiples. Questions about what your assignment is? All right, simultaneously, I'm gonna finish putting up all of the corresponding data for your team projects. And they're gonna be in that folder that I showed you tonight. So by tomorrow, you'll have 2 things to work on this week, which is why this assignment shouldn't be a heavy workload. Because even though this is not a heavy workload, I would assume that your teams are gonna start working on your team projects. So all of the data, which is there now, plus what I'll finish putting in, will give you the ability for each of your projects, Tesla, Planet Fitness, whoever, to basically do your EIC, to do your historical, to do your valuations, and to do your multiple analysis on those companies. Okay, and I'll put up some peer data, so you can also do the multiples on a couple of peers for the companies that you have chosen. Okay, so that's what you should be working on this week. If you have any questions, feel free to reach out. Otherwise, have
So
a good
Professor,
day.
will you be selecting the peers for us? We're not doing that.
I'm going to, just because, like I said, 2 reasons. One, it's kind of hard to figure out some peers. So I'm just going to use the standard peers that the analysts are using. I'll take 2 close peers. And I'm also going to choose peers where the data is not so difficult that it's going to be impossible for you to do an analysis on. So I'm going to try and find reasonable peers to do this analysis. So what you're doing here, for example, in this homework assignment, will make logical sense. Sometimes you get some multiples that are just crazy. And so rather just you tell me, oh yeah, I'd want to do this company, I'm going to just make sure that the peers I give you are reasonable. Any other questions? All right, recording should be up as well. I will see you guys next week. Have a good week.